Welcome to this explainer. Let me ask you a quick question. What if you took your hard-earned savings, invested it into massive real estate towers, or even national toll highways to earn a nice, steady monthly dividend, only to have a quiet, pretty confusing new tax law alter exactly how that money is taxed before it ever even reaches your bank account? Sounds like a literal nightmare for an investor, right? Well, that's exactly what we're diving into today. Most people completely ignore tax amendments. They're usually buried deep inside parliamentary bulletins, and let's be honest, they usually sound like dry, boring accountant speak. But you absolutely cannot afford to ignore this one. President Droupadi Murmu has officially granted presidential assent to the Taxation and Other Laws Amendment Act. With just the stroke of a pen, a major overhaul of both digital payments and real estate tax has become the permanent law of the land. So let's unpack this hidden tax shift. Passed through both the Lok Sabha and the Rajya Sabha during the monsoon session, this is a historic piece of legislation. It directly affects retail investors, the real estate market, and honestly, India's entire financial architecture. In this explainer, we're going to translate all these dense tax concepts into plain, everyday language. Here is our roadmap. First, we'll clearly define what REITs and InvITs actually are. Then, we'll explore the brand new tax rules on distribution payouts. After that, we'll dissect the special corporate surcharge trade-off that's happening behind the scenes. And finally, we'll map out exactly what this whole shebang means for your personal investment portfolio. Don't worry, you are not going to need an accounting degree to follow along. We are breaking this down so anyone can understand how it impacts their wallet. Before we get to the taxes, let's talk about the concept of real estate for everyone. To really understand the new rules, we need to get our baseline facts straight. Historically, buying a sparkling IT tech park in Bengaluru or some massive shopping mall in Mumbai, it was completely impossible for everyday people. It was strictly a playground for ultra-wealthy billionaires and massive private equity funds. So, to understand how regulators finally fix this for the rest of us, let's use a simple analogy. We'll call it the apple orchard analogy. Imagine you and 1,000 of your neighbors want to buy a giant premium apple orchard that produces thousands of boxes of really expensive apples. Now, none of you individually has the 10 crore rupees needed to just go out and buy it alone. So what do? You pull your money together into a shared trust. That trust buys the orchard, hires professional farmers to manage the trees, harvests the apples, and sells them to markets across the country. And then, every single month, after paying the basic farming costs, the trust takes 90% of those profits and drops cash directly into your bank accounts as a dividend payout. It's strictly proportional to your shares. Boom. You are now a fractional owner of a massive asset, earning passive income without ever having to even touch a tractor. That analogy perfectly describes a REIT, or a real estate investment trust. It is exactly like that apple orchard, but instead of apples, a REIT owns high-end corporate office parks that are rented out to global tech giants and massive corporations. It's a shared financial trust that owns premium commercial real estate and distributes those rental profits directly to fractional owners. Owners exactly like you. You put in a small amount of money, and you get a proportional slice of the rent paid by some of the biggest companies in the entire world. And this brilliantly illustrates our next financial tool, the InvIT, which stands for Infrastructure Investment Trust. It operates on the exact same shared financial trust model. But instead of office buildings, it owns multi-crore national infrastructure. We're talking massive power transmission grids, interstate gas pipelines, and busy toll roads stretching right across the country. When you buy a unit of a REIT or an InvIT on the stock exchange for just a few hundred rupees, you become a fractional owner. You earn regular passive income from corporate rent or highway tolls. It is literally a way for everyday people to own a piece of the country's economic growth. However, it's not quite as simple as money flowing directly from a toll booth to your pocket. Behind every investment trust sits a specialized corporate structure. You see, a main trust usually doesn't own the buildings or the roads directly. Instead, it owns them through smaller subsidiary companies known as special purpose vehicles, or SPVs for short. Now, how the money flows from those underlying SPV companies up through the main trust and finally lands in your personal bank account, well, that entire pipeline is governed by incredibly complex tax laws. And here is the absolute kicker. When the government tweaks how taxes are calculated along that pipeline, the size of your final payout directly changes. And that is exactly what this new legislation does. All right, let's dive into the core of the story, the new tax rules. Now, this newly enacted legislation is actually a massive umbrella act. It's an omnibus bill, meaning it tackles two completely different but monumental shifts in India's financial system. We need to mention the first one really quickly because it's huge for daily life. It officially updates the Payment and Settlement Systems Act for digital payments. Specifically, it updates Section 10A to remove the strict zero merchant discount rate mandate for large businesses. Basically, this gives regulators the power to modernize commercial fee structures. But, and this is absolutely crucial for you and me, everyday consumer UPI transactions stay completely free. Okay, with that out of the way, let's get back to the second, much more complex reform within this act, which brings us back to our main story about your investments. This second reform completely rewires the taxation framework for REITs and InvITs under the Income Tax Act. See, when you receive a cash distribution from one of these trusts, it's not just one big lump sum of identical money. Because the trust makes money in various ways, that payout is actually sliced up into 4 different categories: dividend income, interest income, rental income, and repayment of debt. And the taxman treats each of those slices very differently. To truly understand the impact of this new law, we have to focus heavily on that last category, the repayment of debt. Because historically, this is where things used to get incredibly messy for everyday folks. Let me explain the old historical nightmare. Under the previous tax rules, if a portion of your payout was categorized as repayment of debt, it triggered a massive, highly complicated tax calculation. If these specific debt repayment distributions exceeded the original price that the unit was issued at, retail investors, people just trying to build a little passive income, were suddenly hit with a heavy penalty. The money was treated as immediate taxable income, and it was taxed at your applicable slab rate. It was incredibly frustrating for everyday investors. It ate into their returns, and quite frankly, it made doing your annual taxes an absolute headache. People hated it, and honestly, it discouraged investment. So, how did the new law actually fix this? They used what we can basically call the grand tax trade-off. Let's look at retail investors first. The new law finally gives clear, streamlined tax relief to you. It ensures that regular distributions up to the cost of your initial investment are treated fairly. Instead of hitting you with immediate, punitive taxation, they are simply viewed as a reduction in your overall investment cost. This is huge. It makes holding these trusts much cleaner, way easier to understand, and far more attractive for your average saver. But, as we all know, there is no free lunch. Let's look at the corporate SPVs on the other side of this trade-off. To actually afford that massive tax relief for everyday investors, the government tightened the tax rules down at the underlying subsidiary company level. The special concessional corporate tax regimes, specifically under Section 115BAA of the Income Tax Act, have been strictly rationalized. In plain English, this ensures that while retail investors get smoother, lower taxes, the underlying corporate entities cannot exploit overlapping tax loopholes to dodge their corporate surcharge obligations. It's honestly a brilliant balancing act. It helps citizens build wealth while making sure massive corporations pay their fair share. And this calculated compromise has been deeply welcomed by the broader financial industry. As the Indian REITs Association pointed out, removing the tax ambiguity around debt distributions removes a massive dark cloud. Why does that even matter? Well, because when foreign institutional investors, huge international pension funds, and domestic retail buyers are looking to pour literally billions of dollars into Indian commercial real estate and infrastructure, they crave one thing above all else: legal certainty. Capital does not like surprises. By settling this tax debate permanently and making the rules crystal clear, the door is now wide open for massive capital expansion across India. So what is the impact on your money? Let's get to the so what of this whole explainer. Here's exactly why this matters to you, your wallet, and your overall wealth-building strategy. First up, simplify taxes for passive income streams. If you are tired of relying solely on low-yield fixed deposits, gold, or just wildly volatile stocks, REITs and InvITs just became a much more attractive pillar for your portfolio. Calculating your tax liability on this quarterly distributions is straightforward now. You can confidently build a dividend-yielding machine that pays you while you sleep without having a panic attack when tax season rolls around. Second, this unlocks billions for national infrastructure, which ultimately benefits all of us. India needs trillions of dollars over the next 2 decades to build modern toll highways, massive green energy transmission corridors, and smart logistics hubs. Because of this stable, predictable tax framework, international pension funds can now pour money into these projects safely, creating jobs and modernizing the country way faster. And finally, this is really about modern wealth building straight from your smartphone. You can completely escape the traditional headache of physical property. Forget dealing with difficult tenants, paying crazy high maintenance costs, or having all your cash locked up in an illiquid house for decades. Now you can easily own fractions of India's largest, most lucrative real estate and infrastructure assets right from your brokerage app. And if you need the cash, you can sell whenever you want. Let's wrap this up with the final takeaway. To summarize everything we've covered, the presidential assent on this act officially establishes a modernized, perfectly balanced tax framework. It brilliantly protects retail unit holders with simplified taxes while ensuring that the underlying corporations actually pay their fair corporate surcharges. It really is the legal engine that's going to help fund the next era of Indian infrastructure and commercial growth. So, I want to leave you with this question to think about. Are you considering adding REITs or InvITs to your portfolio, or do you still prefer the tangibility of physical property? Understanding these kinds of shifts is what allows you to protect your earnings and optimize your returns for the future. Let me know your thoughts in the comments, and keep leveraging the best tools in our modern economy. Thank you so much for exploring this explainer with me.